Robschild. No investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Tuesday, May 20th, 2025. Today's episode begins with our headline, Put Option Contracts Are Suspiciously Unpopular. I brought this up yesterday, and I've brought it up before, but there's not really anything else to talk about today. Markets are just getting really boring here. Suspiciously boring. So boring that no one wants put contracts. What a put contract is it's a contract that you can buy that says, I have the right to sell this, let's say the S&P 500 at a certain price. And when the price of the S&P 500 drops below the premium paid for that contract, then you make a lot of money. You make a lot of money if the price of the thing that you have the put contract on goes down. And right now, nobody has put contracts. Look at how low this thing is. In the past 3 years, the amount of puts compared to the amount of calls that people want right now is at basically the lowest that it's been for 3 years. And this is right after we had the biggest market correction, I would say, within 3 years. And very importantly, every single time that the put to call ratio bottoms, like here, let's make that a little bit bigger here. Like here, you get a top in the stock market, the orange line here, and it goes down. Every single time we get a major bottom in puts, what happens to the stocks? They go down. What happens here? The lowest it ever was, down here right before the major Liberation Day sell-off, went straight down here. Where are we today? We're near that complacent zone that we were right before Liberation Day. I've bought put contracts before myself, and I'm also not interested in them just because of this rip your face off rally. That's what they do. That's what happens in bear markets. You know, the beginning of the great financial crisis bear market, you had tons of rip your face off rallies that killed all the bears, that made people be like, okay, you know what, I give up. I'm not buying put contracts anymore. And in fact, I'm going to buy calls now because I think it's just going to keep going up. And that's what's happening right now. People have more calls than they have puts. And typically what happens in those scenarios is the market finally goes the other way. I'm really starting to wonder, with me and my crystal ball and all, if right now is the best possible time in all of human history to be buying put contracts when absolutely nobody wants them. That's what markets do. They cause pain, they cause greed, they cause fear. They cause fear of having fear, like in this case. Just like when stocks are at a major bottom, nobody wants to buy them. And when they're up high in the clouds, nobody wants to sell them. So we'll see how it all pans out moving forward. Anyway, community topics. What moves, if any, did you make today? Robschild sits on hands. Coming up, as always, continuous tariff updates. The federal budget for the next fiscal year should be coming out pretty soon, and this is a big one. If Trump decides, hey, you know, we're going to be spending $10 trillion this fiscal year, because I got a lot of stuff that I want to do. Yeah, watch out. I'll lose a lot in that case if he decides to just, you know, go out on a absolute spending spree. Bond yields will go up in that case, at least temporarily. I mean, the cat's out of the bag as far as, you know, the worry over fiscal dominance goes, so hopefully there's some kind of sensibility to that side of things, and, you know, it's not way higher than what people expect. But we'll see. And then on Thursday, as always, initial and continuing jobless claims. My crystal ball tells me any one of these weeks is going to be one of those weeks where we get a surprise to the upside and everybody kind of flips their lid. Could even be this week. We'll see. Could end up being the next shoe to drop after the Liberation Day thing all started. But, well, we'll see what happens. As always, thank you for watching, subscribing, commenting, and supporting. This is how you support, and the subscribe buttons over here. Daily reminders, macro views, no changes right now. One piece of this I might need to adjust, that I'm, whenever you have any kind of viewpoint about what's going to be going on, you're sort of forced into a little bit of cherry picking, and I am a little guilty of that. I'm seeing this, fiscal spending situation as something that, will resolve itself, and that people are overly worried about it. I think that's the way Jerome Powell actually feels about it right now. As he's said before in many press conferences, he said we are not in a fiscal dominant situation, but we're on a path towards fiscal dominance, and if we keep going down that path, it could become problematic in the future. I think that's probably the most accurate way to look at these things. And like I'm saying, like even just this federal budget for the next fiscal year could be really telling. This is not a political stance. This is simply a financial, viewpoint. With these tax cut ideas coming out, that doesn't, you can't cut taxes at the same time as not lowering your spending. It's like I said the other day with someone with a credit card, if you have to spend, however much money a month, and you don't make that much money a month, it's going to be a problem. It's going to be a problem. There's no way out of it. You can't just keep spending more and more and more and not be making the money. You either got to cut your spending enough so that the money that you're making can cover it, or you got to somehow get more money coming in, not cut the money coming in, which is, tax cuts, that's what they do. They cut the money coming in. So, I'm sort of forced into seeing sort of the bear side of bonds, especially right now as the 30-year bond yield is now at 5%. I am, I can't help shaking my boots a little bit, being like, how high can these darn things go? I don't think they can go much higher. I think if they do go much higher, it's going to be breaking markets, considering, it's not just the United States government that has to pay larger and larger interest payments on their debt. The corporate America, everybody that borrows money to buy a car, to buy a house, mortgages, companies that are issuing, their corporate bonds, they have to pay premium on top of that rate. And so it costs them even more to have rates be higher and higher. That's how banks can blow up. And so the point is that, yes, the spending cuts are... Sorry, I think my mic checked out there for a second. I was saying, yes, there are spending cuts and tariffs, but is it enough? If rates stay higher, the interest payments are going to be really high. The rates have to go down. A lot of people are saying the only way out of this is to just print their way out of it and accept the fact that we're going to be seeing higher and higher and higher inflation. I know that's not the way I see it. The way I see it is that we simply need lower rates, and in order to get lower rates, we sort of need a correction in the stock market in order for lower rates to happen. We need to go through the real business cycle. We need to flush out the weaker, lesser good credit. Yeah, it hurts, but in the end, it's what's going to make, the longer term financial situation of the United States a healthier, better one. Anyway, As you can tell, I've been thinking a lot about this kind of stuff. Again, especially while the 30-year bond yield is sitting around 5% right now. I'm not alone wondering if it's going to go higher. With that said, no changes to the Robschild portfolio. Yes, I do still have 55% of my portfolio in long-duration treasury bonds. And no changes to the crystal ball readings still right now. Onto the charts, let's start with the SPX, the S&P 500, dropping by a whopping 0.4%. I mean, how boring can you get? TLT, my favorite place to be in this fight zone, as I've talked about before, with these gap fill areas. Finally, we're in the fight zone. This is normal for a chart pattern, from a chart pattern standpoint. You want to see everybody, including the Federal Reserve themselves, really flip their lid. Wait to see what happens if TLT actually drops below the lowest low of this whole cycle that we had in October of 2023. If that does happen, I highly suspect we will go straight back into some sort of yield curve control situation where we're like maybe keeping rates higher on the short end, and then they turn on the QE, where they buy up bonds on the long end. Because if this gets out of control, oh, look out. All businesses will go bankrupt the way I see it. The volatility of bonds expressed in the MOVE index, forming, I don't know, from day to day, looking like a little bit of a bull flag. Again, like I said, we were dropping, and now we've been looking like we're sort of at least going sideways here. If the MOVE index pops to the upside, like I've been saying on many shows, it could be TLT actually popping to the upside. If we get another stock market crash and we get violent amounts of money pouring into longer duration treasuries, for example, which very easily can occur right now in this kind of environment, by the way. It doesn't have to, but it can. The MOVE index will be spiking as a result of that. Next, I want to talk about Bitcoin after breaking out, forming, and then looking like we almost had an engulfing day to the downside, and then turning into sort of a bull flag. Like I said yesterday, it looks more bullish than anything, at least on a simple chart pattern standpoint. Bitcoin is a risk asset. This is not a safe haven asset. Sometimes we go through long periods where things are in a risk off mode, and we're not in that mode right now. And many people are, including myself, are scratching our heads thinking like, well, shouldn't we be in this situation with all of these tariffs, with all this extra money that has to be paid? But hey, it's a game of musical chairs, and the music's still playing. The S&P 500 is not the only boring market. The dollar index dropping a little bit today, looking like going sideways more than anything, not developing any kind of bullish or bearish pattern. Same thing with crude oil. These tiny little candles going very, very much sideways, preparing obviously for a bigger move, but just going absolutely sideways. Copper as well, Dr. Copper with a PhD in economics, after all of this violence from the beginning of March to the end of March to Liberation Day, all this craziness, just coiling up here. Not sure if he wants to get more expensive or cheaper here. The breakout, it's these chart patterns, they are on one hand just a bunch of pile of baloney, but on the other hand, they really do function this way. When you have something that's tightening up, going sideways, people are fighting what the price should be. All of a sudden, when it does break out, the longer the fight is, the bigger the breakout. That's what typically happens. Silver, finally something that wasn't so terribly boring. Silver went up by 2.25% today. And if we just look at just a few little trend lines here, a little bit of a breakout here. So, yeah, if we get like a confirmation higher, I don't know, we have potential bullishness happening in silver right now. Gold also getting cautiously bullish, I'd say, going up 1.84% today. Another rare metal, palladium, shot up today. This doesn't always have the most interesting movement, but it went up by 4.73% today. It's a large move to the upside for palladium. My understanding is that this metal is rarer than gold and less than a third of the price. And so, if you're interested in metal markets, some people are very interested in palladium, including myself. The way I like to get exposure to rare earth metals is through the ETF REMX. It represents 5% of my own portfolio. And although palladium shooting up and these various metals starting to move a bit, this fund not moving much right now. If palladium, cobalt, I think various other, lithium is a big part of REMX. Other metals that are involved with batteries and magnets, especially, if those start spiking, REMX is a nice place to be. These are companies that mine these metals from the earth and from recycling, actually. And if you've watched the show for a while, if you don't know this fund, REMX, check it out. Check out the price that this fund was in 2011. This is one of these Ben Graham areas that has been very suppressed for a very long time. This is one of these sort of sweet spots that has a lot of potential to have a lot of legs to the upside, in my opinion. I want to bring up IWM, the Russell 2000 ETF. As I've been saying now for the past 6 trading days, coiling up, still not really getting to a higher high. More of a double top. We had lower lows, lower highs, and now we have this equal high here, not able to break out to the upside. The probabilities still favor right now because this is forming a bull flag that it wants to break out to the upside, but typically the longer that this goes, the less momentum that it has to break to the upside. So once you get past a week, 2 weeks, then it's starting to favor actually the downside. So again, all a little bit of tea leaves. I'm sensing, in my crystal ball and all, that things are about to get more bearish sooner than later, especially with this put to call ratio thing. Nobody wants puts right now. So it's the perfect time for Mr. Market to get bearish. I talked yesterday about XLU, an ETF that is of the utilities. It's the utilities sector, basically at near all-time highs, and then going up again today. This functions as a defensive ETF. People will put their money in here if they want to feel defensive, but like I mentioned yesterday on yesterday's show, .com bust and Great Financial Crisis, this fund itself dropped about 50% or more in both cases. But its bullishness, especially compared to the S&P 500, not at all-time highs. This is basically at all-time highs. It just says that there is a bit of sector rotation into more defensive plays. Next, SOFR rates still near the Fed funds target floor, suggesting not a lot of leveraging into the market. Junk bond credit spreads, after widening crazily and then dropping, now just going sideways more than anything. Spreading a little bit for Monday. Again, this is 1 day late information. Also, break-even inflation rates not really doing much, just really going sideways here, undecided where to go. Like I've been sort of warning through this video, I'm not... When we see the 30-year bond yield at 5%, near the highest that it's been in a very, very long time, you got to look at the break-even inflation rate. What's going on here? If this starts going up, then bond yields will probably go up until the Fed presumably has to step in with more QE, which is how I think this may end up playing out if it does play out that way. But for now, the break-even inflation rate, it's not going up dramatically. If anything, we still have lower highs and lower lows. Yeah, it is. It's lower highs and lower lows still since February. It is something to keep a very close eye on. If this starts gaining momentum to the upside, yeah, watch out. It will mean that the Fed funds futures will have to start pricing in not cuts anymore, but hikes to the federal funds rate. Next, 10-year minus 3-month Treasury. Again, when it goes below zero and then goes back above zero, that's when you get your recessions. We've had the deepest, longest inversion pretty much of all time. And for all practical purposes, I consider us to still be inverted, even though it's not inverted. This close to zero is saying that people accept just like a tiny, tiny bit more yield from the 10-year than the 3-month right now. Just a fraction more, which is abnormal. Normally for, 10 years, you want a little bit more than just, 0.1% more. So I consider this to be still inverted, basically, because we've been stuck at this zero, going up and down, above and below zero. Another thing that can occur is if we start pricing in Fed hikes. If the inflation, the 10-year break-even inflation rate starts really spiking up, the long bond yields start going up all at the same time, then we could see hikes that would actually invert this again back into inversion, back to like, nope, the Fed's got to put its hands back around the neck of the economy and say, slow down, buddy, you're getting too hot. Last chart of the day, if you've followed the show, I bought UNH stock very recently, and my selling price is $333. We have been getting to that price very quickly. We could get there as early as tomorrow or later this week at this point. It's turning into sort of a blow-off bottom type of pattern. I will be selling at $333, or if it happens to be higher, I'll sell it then, because it's considered a fair price. I'm not looking to sell this at a premium, but buying it at that much of a discount and then selling it at a regular price, this is like perfect, like 101 Benjamin Graham, not exactly bargain. It's basically a bargain deal. I think we might be able to categorize this as sort of a bargain deal. But anyway, that's all for today. That's all from me and my crystal ball. This week, there's not a whole lot of data. The main things to look out for is the federal budget. What is it? Number one. And then the only other thing this week that I see interesting is potentially the jobless claims, initial and continuing claims on Thursday. At this point, I'd say probabilities favor that it's not going to be a non-event, but something to just really look out for. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.